let's bring in CNBC contributor David Zervos, chief market strategist at Jefferies. David, great to have you with us.
Good to be here, Melissa.
How does this set the stage for Kevin Warsh, given the most divisive meeting since 1992 and Powell staying on the board?
I mean, it's a message, right? It's a message to Kevin. I don't think it's a pleasant one, but I think Secretary Bessent said it very well. This is outside the norms. This is, in all likelihood, a political decision that is going to keep the board from falling into majority hands of the president. And I think it was actually even more aggressively against Kevin. I would go further than the secretary and say that, I almost felt like at one point during the press conference that, I felt like Jay was sticking around to be like the hall monitor and make sure that the chair builds consensus as is, part of the norms of building consensus. And if he didn't, that Jay would be there to kind of push it back in line. I found that all very, I just think it's troubling. I don't understand why there's this political decision making, but I get it. I guess I get it. I guess I get the political side of it, but it is a political decision. And I think we should see it as that.
Well, I mean, to be fair, what is outside all norms is trying to remove a Fed governor,
sure,
taking them to court, investigating a Fed chair. I mean, all of it is outside. Regardless of where you stand on the political divide, all of it is out of the norm. But at the end of the day, we're now pricing out completely Fed cuts. Yeah. Where do you see the first cut able to happen, likely to happen, possible?
Well, let me put it this way, Melissa. I actually think we're still likely to get a cut by the end of the year. I think Kevin could make a pretty sound and cogent case from the supply side for rate cuts, as well as the trading off of balance sheet for rate cuts. But that's beside the point in a sense, because what we really want to get the answer to is, what does it mean for broader markets? And here's the fact. Since this war started, we've priced out 2 rate cuts, and we've seen energy prices go up almost $50. It's from 60 and change to almost 110 today. So $45, $50. We have seen the stock market rally 4 or 5% in that time period. That's an incredible statement. So we've taken out 2 rate cuts, and we've seen the energy complex rise 60% in price, and the market hasn't skipped a beat. Imagine where we would be if this energy story had never happened, if Iran never happened. I think we'd be up 10 or 15% for the year, if not more. So I think the real story is that we don't need the rate cuts. We've got an incredible momentum. We've got productivity. We've got clarity on the tax side. We've got all sorts of drivers from a business-friendly environment that are just making returns on capital, earnings, profits, and growth for companies very, very strong. And the fact that we don't have the rate cuts, it'd be nice to have them. We could probably get a little more out of them, but it's not going to get in the way of this economy, and it's not going to get in the way of the stock market.
David, Tim, I agree. We do not need a rate cut, and risk assets tell you that, and the wealth effect, will then take that even further. But we've been having this conversation for the last week or so. Are equities right? I mean, if you look at rates markets, they're telling you a different story. The equity market's always last to know. I'm just curious. Look, what we see in earnings season has been extraordinary, and it was expected to be extraordinary. I'm just trying to have you just reconcile that one more time. You think equity markets are making the right call?
I do, and I think they're telling you something even more, that they don't need the rate cuts. It would be nice to have them, but they don't need them. But more importantly, if we look at the currency markets, and even if we look at the long-term interest rates, I mean, 10-year note yields are up 20 basis points during this whole storyline of the last 2 months. That's one bad day on a payroll number, and the dollar's basically flat. So I think all of your macro indicators are basically suggesting that this is not a major macroeconomic story that's going to get in the way of this stock market. And if anything, all of this makes me even more bullish, because if we're able to withstand the 1-2 punch of the taking out of these rate cuts, 2, actually a little more than 2 since the beginning of the year, and this $45 rise in oil prices, which doesn't look like it's going away anytime soon. That means there's just so much momentum underlying this market to be able to withstand that it's a great storyline for when this all fades back. And when it does, which it eventually will, and we won't be talking about the Strait of Hormuz anymore, and oil will come back down, and we'll be on to the next, major crisis, whatever that is, that's going to try to drive stocks down, but in the end won't. I think we've just got a lot of momentum that's going to take us into a pretty incredible year by the end of the year. So this just makes me so much more positive as we go into the end of 26, or toward the end of 26.